Good day, everyone. Welcome to the weekly note of GTC Traders. This is a feature we do each week, as you can tell if you click on the little category for the GTC weekly note. This is something that we do each week. If you are new, I am the senior partner of a separate private proprietary firm, and we decided, hey, how about we put our weekly note up? We're not by any means the only one that does a weekly note. This is something that's very common among many firms, weekly note or a daily note. And we thought, hey, how about we just make this real easy on ourselves? How about we just copy and paste sort of our weekly note from our private proprietary firm and put it over here on GTC Traders. So that is what we do. And the article itself has all of the vagaries usually of different thoughts as far as the economic calendar for that week and what we see in interest rates and various markets. If you're sort of curious about a weekly note, if you go to the GTC Traders YouTube page and you look at something like the playlists, so you click over at the playlists, come down here, go to the GTC weekly and daily note playlist, look at the full playlist. The first three, maybe even the first four videos really describe why so many firms do this. Okay, so why so many firms have a weekly and a daily note, really what is the value of a weekly and daily note, what it is and what it is not. So that's just for folks who are new. And then as I will now, I usually yabber on about the vagaries of each week. Good day, everyone. Today is January the 22nd, 2024. A few of my musings on interest rates and inflation and sort of a lot of expectations and discussions going around interest rates and the cutting of interest rates or the stabilization of interest rates or the normalization of interest rates here in 2024. There has been a thought floated, and I see its merits. I see where they're coming from, that there's sort of a tug of war, and I hope I'm sort of stating the debate correctly, but there's sort of a tug of war between wealth-flation. In other words, one's wanting higher asset prices, right? Higher asset prices, as if that's a good thing, and it's not necessarily a good thing. But some people just think that up equals good. I don't know why, but they do. It's a very deep cognitive bias, which I have a lot to say about in the future. And honestly, you saw that last week, right? All-time highs, look, we're making all-time highs, which I find absolutely hilarious. All-time highs are not that big of a deal, right? I mean, seriously. It's like in 2016, guess what? All-time high, all-time high, all-time high, all-time high, all-time high, all-time high, another all-time high, all the way up. Oh, look at that, another all-time high. Oh, an all-time high, all-time high. You know what I mean? And you have to wait some if there's a period of drawdown. And yes, we're seeing all-time highs because we had to deal with that drawdown, very healthy drawdown in 2022 due to the adjustment of interest rates, inflation, all of that. We all know all of that, right? But I find it funny, you know, that's the current news blurb. All-time highs are not that big of a deal. Regardless, we have all-time highs, and the entire conversation is many see that as the great thing and what you want. And even some policymakers have made incredibly stupid statements about, you know, higher asset prices being a good thing. Okay, whatever. Like I said, it's a very deeply held cognitive bias. There's been a discussion about real interest rates, right? Real interest rates being take nominal interest rates, subtract inflation out of it, you have real interest rates. So what happens if inflation's coming down, right? And in which case the Fed would have an excuse to cut interest rates. Not really seeing that in the probabilities at the moment for this next FOMC. For the meeting date of January 2024, what do we have? Like a 97% probability we remain right where we're at, cutting by a quarter, 25 basis points is like 2.6%. So not really seeing much on the horizon, honestly. And the market doesn't expect a lot on the horizon for cutting of interest rates for the next meeting. Regardless, that's the concept, right? They will have an excuse to cut interest rates because if inflation stabilizes and rates remain the same, well then there you go. However, I would I would just point out some issues. Okay, I don't want to be overly critical or anything. I'm just saying you always have to consider the other side, right? That is assuming static data, first of all. In other words, data stays where data is at the moment, and that can never, ever be assumed. So data it can never be assumed because it just never happens, right? Discrete quanta, I always say this and I repeat it over and over again, discrete quanta released onto a continuous system, complexity, there's absolutely no way to predict. So it's assuming the data stays static, which, as we know, absolutely will not happen. And as well, it's the Fed's own stated expectations. Now, there were some comments made about possibly cutting the rate in 2024. They walked that back. Okay, they walked that back. So there's a few things I would like to unpack there. Please keep in mind that although some policy maker that's maybe not even in the Fed makes a statement, the Federal Reserve System is more of a complex system. It's not like one guy decides everything. So it's a complex system. Not a complex system, but it's it's not like a king sitting on the throne with the scepter saying interest rates shall be. So one policymaker makes a statement. It doesn't mean the Federal Reserve simply going to do what that one policymaker stated that's not even in the Fed. You can't assume that data, as we said before, is going to remain static. And I would say you really need to get a serious history on the Fed when it comes to inflation. They're always late, right? Because, and I've said this before, because they use models that have tamed down volatility so that they don't get head fakes. Well, because of that, right, and they're using models, and they sort of lost the plot on the models they were using that tames down volatility so they don't get head fakes. The problem with that is you have a model that tames down volatility so you don't get head fakes, right? So in other words, when a severe shock comes to the system, it's too late, right? Because your model is discounting that. It's already tamed down the volatility. And when it is something serious, as we saw in late 2021, and as I and others were saying, no, this is not transitory inflation, they're late to the party. That being said, the Federal Reserve as a system, when they do believe they have an inflationary problem on their hands, is very serious about battling inflation. So backing up just a little bit and to encapsulate what I just said, I think you need to get a very severe history lesson on the Fed when it comes to when the Fed believes we have an inflationary problem. They're very serious about it. Read a lot of the working papers, read a lot of the history of the Fed. They're very, very serious about battling inflation. Number two is what I just said. They're always late, right? So they will continue to battle inflation, perhaps even when they don't need to. Why? Because the Fed is late to every turn. That's one of my criticisms of the Fed is they don't think like traders. They don't think that they're not anticipatory at all. We hear that all the time, right? Data dependent. Well, that means you're lagging. And the last point I would sort of point out is the Fed's own stated expectations. Probably what I'm watching more than anything else right here. SOFR, March of 2025. Well, why am I watching that? Well, again, as I was saying, the Fed's own stated expectations. You come over to the weekly note, there is a huge disparity between where we're at in the March 2025 interest rate sort of expectations, as far as in SOFR market, and where the Fed thinks we'll be. So we get a severe sell-off in the March 2025, it really wouldn't surprise me. But that is the battleground, right? I don't know at this point. I will tell you that I'm leaning more towards a normalization of interest rates being higher. We had 40 years of a bull market in yields. In other words, higher and higher and higher interest rates from 1941 to 1980 or so. And then from 1980 until just recently, we had a bear market in yields, lower and lower yields. The question I have in my mind is, are we at another transition point? And the transition points can be a real bear to get through. That's where all the conflict happens, is during those transitionary periods. The last one we had was 1941. So that ought to tell you something, right? 1941 to 1981. So, and I don't even mean geopolitically or wars of that nature. I'm just saying in the markets themselves, it's very disruptive. Okay? And when you look at what's going on geopolitically, the question that I have in my mind when I look at markets and the decisions I have to make is with global supply chains. And yeah, again, you see it, it wasn't just 2020, you see it ongoing. Look at what's happening in the Red Sea at the moment. I've said this before, I'll say it again. I think the world we had from like 1996 to 2020 is over. And eventually the United States looks more and more and more, and you are already seeing signs of this, of looking at the rest of the world, looking at the global supply chains and sort of giving everybody the middle finger and saying, screw you guys, I'm going home. And you're seeing more and more companies turn to vertical integration. So does that become normalized, and do higher interest rates become normalized? Well, I'll tell you what I'm looking at. I'm looking at what you see right here. I'm looking at that March 2025 SOFR. You see a massive sell-off in the March 2025 SOFR. It would not surprise me. I'll just say that. Those are the questions that are in my mind as we look at the weekly note. And all of the above has simply been what it always is. It's simply been our thoughts, not yours, for whatever the heck day it is. As always, stay safe, trade well, and remember that love doesn't cost a dime.